Imagine you're worth $10 billion. Not someday. Today, your companies are thriving. Your investments have multiplied. Your name appears on lists of the world's wealthiest people. And today, you need $100 million. Most people think the answer is obvious. Sell a small portion of your fortune. Take the cash. Walk away. After all, if you're worth billions, why would you ever need a loan? Yet every year, some of the wealthiest people on earth do exactly that. They walk into private banks, not to deposit money, but to borrow it. Sometimes hundreds of millions of dollars. Sometimes even billions. It sounds completely backwards. If someone can afford almost anything, why would they willingly pay interest? Why owe money when they already have more money than they could spend in a lifetime? The answer has almost nothing to do with cash. It's the same question millions of people ask. And on the surface, it makes perfect sense. But the moment you understand how wealth actually works, the question changes. Because billionaires rarely think about money the way most of us do. They think about ownership, control, taxes, leverage, time, and understanding the difference between cash and assets changes everything. To understand why billionaires borrow instead of selling, we first have to understand a simple truth. Most billionaires aren't nearly as cash-rich as people imagine. And that's where our story begins.
Most people imagine a billionaire opening a bank account and seeing billions of dollars sitting there. But that's almost never how wealth works.
In reality, most billionaires don't own billions in cash. They own something far more valuable. When we hear that someone is worth $10 billion, our minds picture stacks of cash, vaults, private islands, gold bars. But net worth isn't measured by the money sitting in a bank account. It's measured by everything a person owns, minus everything they owe. For many billionaires, their wealth exists in businesses, company shares, real estate, private investments, and ownership of assets that continue producing value every single day. Imagine this pie represents everything you own. Notice something? Only a tiny slice is cash. The rest isn't sitting in a bank. It's tied up in assets. That means your wealth exists on paper until you decide to sell. Imagine owning a company worth $10 billion. You don't have $10 billion in your wallet. You own something that investors believe is worth that amount. Your fortune rises and falls with the value of the business. Some days, your net worth can increase by hundreds of millions. Other days, it can fall by the same amount, without a single dollar entering or leaving your bank account. This is one of the strangest parts of modern wealth. A billionaire can become richer while eating breakfast and poorer before finishing lunch, not because they bought anything, not because they spent anything, but because the market changed its opinion about the value of what they own. So when people ask, why don't billionaires just sell some stock? They're really asking something much bigger. Why would someone sell part of the engine that created their wealth in the first place? Because once you understand what billionaires actually own, the next question becomes impossible to ignore. If selling isn't always the smartest option, what happens instead? Why do banks happily lend hundreds of millions of dollars to people who refuse to sell? That answer changed modern wealth forever. So now we know something important. Most billionaires don't keep their wealth in cash. Their fortune lives inside the businesses they own. Which brings us to an obvious question. If they need money, why not just sell a few shares? Imagine you build a company from the ground up. Every late night, every risk, every setback. Now imagine that company becomes worth billions of dollars. If you begin selling large portions of your ownership, you're not simply taking cash. You're giving up part of the very engine that created your wealth. Every share sold means owning a little less of your future. Ownership isn't just about today's value. It's about tomorrow's opportunity. If the company doubles in value, the shares you sold no longer participate in that growth. What seemed like a small decision today could become a much larger sacrifice years later. For many founders, that's a trade-off they think carefully about. There's another reason selling isn't always simple. In many countries, selling appreciated investments can trigger capital gains taxes. That means a portion of the proceeds may go toward taxes, depending on the laws where you live and your individual circumstances. Tax rules vary by country and can change over time. For large shareholders, understanding those rules is an important part of long-term financial planning. There's another challenge. Markets don't just react to numbers. They react to signals. When investors see a founder or major shareholder selling a significant amount of stock, some may wonder, do they know something we don't? Sometimes there are perfectly ordinary reasons for a sale: diversification, philanthropy, taxes, or personal planning. But perception can influence markets just as much as reality. Many successful entrepreneurs spent decades building ownership, not because they wanted to collect stock certificates, but because ownership gave them something far more valuable: influence, decision-making power, a claim on future growth. Selling too much, too quickly, can slowly weaken all three. Cash can solve today's problem. Ownership has the potential to shape tomorrow. That's why many wealthy individuals look for ways to access liquidity without immediately giving up the assets they've spent years building. He pauses, looks directly into the lens. And that's exactly where banks enter the story. So if selling isn't always the smartest option, how do some of the world's wealthiest people gain access to cash? The answer begins with something they already own. Instead of selling valuable assets, some wealthy individuals use them as collateral for a loan. Think of it like this. When you buy a house, the property often serves as collateral for a mortgage. In a similar way, certain investments can sometimes be used to secure a loan. The asset stays in your ownership, while the bank lends money based on its value. Notice something important. Borrowing isn't free. You're paying interest, and the loan eventually needs to be repaid. But unlike selling, you may still own the underlying asset if the loan terms are met. For someone who believes their business will continue growing, selling today could mean giving up tomorrow's gains. Borrowing may allow them to meet short-term cash needs while maintaining long-term ownership. But this approach only works if the borrower can manage the loan responsibly and the value of the collateral remains sufficient. Private banks don't hand out enormous loans simply because someone is famous. They evaluate the quality and value of the assets offered as collateral. The stronger and more stable those assets appear, the more confidence a lender may have. Every agreement depends on the borrower's circumstances, the lender's policies, market conditions, and risk assessment. At first glance, borrowing against wealth can sound like a shortcut. It isn't. It's a financial tool, one that comes with obligations, costs, and very real risks. And those risks become impossible to ignore when markets begin to fall. Because borrowing against valuable assets works best when those assets hold their value. But markets don't always move upward. And when they fall, everything changes. So far, borrowing against valuable assets might sound like a smart financial strategy. But every financial tool has a downside. And when markets begin to fall, the rules change. Imagine you've borrowed money using your investments as collateral. Everything seems stable. Then the market drops. Suddenly, the assets backing your loan are worth less than they were before. From the bank's perspective, the risk has increased. In some situations, a lender may ask the borrower to provide additional collateral or reduce the outstanding loan balance. This is commonly known as a margin call or collateral call, depending on the type of loan and agreement. If the borrower cannot meet those requirements, some assets may be sold to reduce the lender's risk. History has shown that markets can move much faster than anyone expects. Periods of optimism can quickly give way to uncertainty. That's why leverage has the power to amplify both success and loss. Used carefully, it can provide flexibility. Used carelessly, it can create serious financial pressure. The lesson isn't that borrowing is good or that borrowing is bad. The lesson is that every financial decision comes with trade-offs. The most successful investors don't ignore risk. They spend their lives learning how to manage it. The strategies used by the wealthy aren't powerful because they're complicated. They're powerful because they're built on careful planning, patience, and disciplined decision-making. Understanding those principles is far more valuable than copying any single financial strategy. When most people think about wealth, they think about cash. But after everything we've explored today, we know the real story is much more complex. The world's most successful investors rarely focus only on today's money. They focus on tomorrow's ownership. They ask different questions. How can I build something that lasts? How can I preserve what I've already built? How can today's decisions create opportunities years from now? Those questions shape the choices they make. The lesson isn't that everyone should borrow against their investments. For many people, that wouldn't be appropriate. The real lesson is understanding how successful investors think. They often spend more time protecting valuable assets than spending the money those assets could produce. Every strategy we've discussed today comes back to one idea. Ownership creates opportunity. Cash can solve today's problems, but carefully managed ownership has the potential to create value for years to come. That's why many of the world's wealthiest people think differently. Not because they know a secret, but because they understand the long-term consequences of every financial decision. If this documentary changed the way you think about wealth, then it achieved exactly what it was meant to do. Because understanding money isn't about copying billionaires. It's about learning the principles behind their decisions and applying them wisely to your own life. Next episode, how Warren Buffett built his first million. Before becoming one of the richest investors in history, he was simply a young man with an unusual understanding of business, patience, and compounding. His first million wasn't built overnight. It was built one decision at a time. Wealth isn't built by knowing every answer. It's built by asking better questions. I'll see you in the next American Wealth Files.